everybody. Today is August 2nd, 2023. I am Ashley Wilkins, Senior Wealth Manager with the Rice Partnership, and I have Orest Saikevych here, our Chief Investment Officer. Hi, Orest.
Hi, Ashley. Hello again, everyone.
So today we want to talk about recent news, and that is the downgrade of the U.S. credit rating. Yesterday it was downgraded. Can you give us a history of previous downgrades before yesterday?
Okay, well, until August of 2011, U.S. Treasury debt was rated AAA by all three major rating agencies, Moody's, S&P, and Fitch. In August of that year, S&P downgraded U.S. Treasury debt due to governance issues and also increased deficits from the great financial crisis. The governance issues, they cited the debt ceiling limit and the extended brinksmanship involved in Congress, and which raised the possibility of a default if legislation was not passed. Well, after a lot of back and forth, it was passed overall. So overall, that's where we stand right now. Is S&P is at AA plus. Fitch just yesterday downgraded U.S. credit from AAA to AA plus. Moody's is still at AAA plus.
What were the factors that led to Fitch's downgrade yesterday?
Okay. Fitch cited repeated, and this is a quote, repeated debt limit standoffs and the last minute resolutions that have eroded confidence in fiscal management, which is very similar to language S&P used 12 years ago. Also, Fitch is concerned about the expected fiscal deterioration of U.S. Budget deficit over the next 3 years. Interestingly enough, Richard Francis, who's the Fitch senior director who issued the downgrade, mentioned that suspending or getting rid of the debt ceiling limit would probably help overall. So as you can see, the reasons are very similar to the S&P downgrade of 12 years ago. Governance issues and also increased government deficits in the case of S&P of 12 years ago from the great financial crisis, and this time around as a result of the pandemic and some of the post-pandemic legislation that was passed.
So what are the overall investment implications for investors?
Okay. Overall, I think the implications are more longer term in nature. Keep in mind that the U.S. Treasury market is still the largest and most liquid in the world. And also, even though Fitch now is going to AA plus as far as rating is concerned, AA plus is still very, very highly rated investment grade. And also, the U.S. Is acting as a defense umbrella for a lot of the AAA credits, especially in Europe. They don't have to spend that much on defense, and so they're able to maintain a AAA credit rating. One other thing is that U.S. total debt, when you count federal and state and local and corporate and consumer debt, the overall profile is not bad. The federal government debt profile is the worst. State and local is not an issue because most states and localities have to, by edict, balance their budgets. Corporate debt is in fairly good shape, and that's one of the reasons why the economy is doing better here. Corporations are in much better condition than they were during the great financial crisis. Also, consumer balance sheets are in much better shape this time around. So, and I mentioned stronger than expected economy. That will help, especially as far as tax receipts being higher than expected. That should help with the deficit. Keep in mind also that the silver lining in the student debt resolution, where the debt has to be repaid, that will relieve the Treasury about $300 billion burden as far as the deficit is concerned. So we have these offsets too. So overall, I would say it's similar to a person going to see the doctor, and the doctor says you're overweight, you should watch your weight, otherwise you might have issues. And then the patient coming back after a while, and the doctor says you gain more weight. If you don't watch out, you'll have diabetes. It may not be a heart attack, that's an acute one-time event, but it's kind of a steady erosion of your health over time if you don't do something. And I think that's probably the best conclusion to draw out of all this.
Thank you, Orest. We appreciate your insights as always and look forward to the next video.
Thank you very much. Take care, everyone.